and topical, subject that we can discuss, and that's technology and disruptors and enablers in technology. So today I'm really excited to have my colleague Kyungju. Say hi.
Hey everyone. Hi everyone. Kyungju from Endowus.
And three other wonderful speakers from three of our most important strategic partner fund management companies. So I'm just going to let each of them introduce themselves. So we'll start with Ben.
Hi everyone. Good evening, everyone. I'm very happy to be here. I'm Ben Bay from BlackRock. I'm in the fundamental equity division, product strategist here. Thank you.
Great, Radhika.
Hi, my name is Radhika Suri. I'm the investment director for Fidelity's Global Equities franchise. Nice to meet you all.
Great. And Paul, last but not least.
Hi, good evening, everyone. And firstly, I would like to thank you as well for being here and taking time off your busy schedules to be with us. And I also would like to thank Endowus as well for the invitation to share with you a bit more about the technology space. My name is Paul, and I'm from the Franklin Templeton Wholesale Distribution Team, and I'm based in Singapore. And I'm looking forward to this event. Thank you.
Sounds good. We're all looking forward to this. Thank you so much for all of you being here. We have 4 companies represented, so we have 4 sets of disclaimers, guys. So really excited to share the disclaimers with you from each of these companies. You can screen capture and compare how they're different if you're really excited about this area, if you want to go into compliance and legal. But really also most excited to introduce Endowus's new satellite portfolios. Now, a lot of our clients have been asking for this, and we've worked really, really hard to offer what we believe is the best-in-class portfolios in building satellite positions. Tomorrow evening, today's technology team's preempting this, but tomorrow is the official introducing of the Endowus satellite portfolios from the various members of the Endowus Investment Office, including Wei Mei, Yu Lin, Yu Han, and Kyungju again, and myself. Presenting to you tomorrow at 7 p.m. Exact same time, same place, and going through each and every one of those portfolios, how we built it, why we built it, why you should invest in it, and what to expect from it. So please join us tomorrow. Slido poll, our usual, go-to solution to do Q&A. Please go in there, put the number in, put your questions that you want to, your burning questions to the panelists today. And we'll look at it, and you can upvote. I don't think you can downvote, but you can upvote it. And the most popular questions will be the first ones that we look at to answer. So please stay on for the Q&A session at the end. Very quickly, for those that have never heard of Endowus and don't know who we are, Endowus is a digital wealth platform. It's the first digital advisor for all of your money here in Singapore, cash, CPF, and SRS. It's the only digital platform where we've really heavily invested in the technology to solve both private wealth and public pension, as the first and only digital advisor approved by the Singapore government to manage CPF investing and SRS, the supplementary retirement scheme. But we are a total wealth platform. We're not trying to be just a robo. We are managing all of your wealth, from short-term cash, core allocations to satellite to individual fund purchases as well. We have the FundSmart platform, which is the lowest cost platform here in Singapore, backed by global strategic and venture shareholders like SoftBank and Lightspeed, UBS, the biggest private bank in the world, Samsung and Singtel as well. And we've been receiving many awards too. So please check out the app and download it. And if you haven't done so already, check it out. Okay, and this is what I'm talking about. We have low fees across the board, across our platform for all our solutions. We feel that cost is the single biggest reason why many investors have poor outcomes. There's heavy cost in investing here, especially in Singapore, but across Asia. So we're trying to lower cost at every level. And we've introduced new pricing for FundSmart, where if you buy a single fund, our platform fee plunges to 30 basis points. And all our solutions would be offered at that low rate. And we are actually accessing institutional funds and 100% rebating of trailer fees, making us the lowest cost platform, cheaper than any bank or broker or fund distribution platform out there. At this point, I'm going to hand over to Kyungju to introduce the various funds that are available on the FundSmart platform in Endowus, And many of these funds come from the three esteemed, technology investment specialists, BlackRock, Franklin Templeton, and Fidelity. And Kyungji will go into a little bit more detail to introduce each of those funds that are on the fund platform.
Sure, thanks, Sam. So as you all know that Endowus Investment Office, we're always looking out for the best-in-class funds to offer to our investors. And similarly, for the purpose of technology investing, we have gone through the thousands of range of funds available in the universe to make sure that the funds that we offer you are best in terms of not only performance, but also in terms of their unique investment focus and their unique investment processes. So here we go. We kickstart with the two BlackRock funds, the Next Generation Technology Funds, as well as the World Technology Fund. So some of you may ask, hey, why are there two funds from just BlackRock alone? And this is really because of two funds. They're really unique on their own. They offer distinct characteristics. So for example, the Next Generation Technology Fund, they invest primarily in opportunistic companies. So these are emergent companies. Maybe these companies are smaller than the others. They're maybe younger than the other, but then they have the potential to become leaders in the technology space in the future. Whereas for the World Technology Fund, this one is more traditional, if I can put it that way. It invests in both opportunistic as well as core companies. So core companies are the more established players in the space. And these two funds, they invest across different market caps, different regions, different geographies and sectors. So investing in these funds can give you a diversified approach to investing in technology. So as you can see, both funds are available in both cash and SRS. And we have arranged for a pretty good level of rebate for the World Technology Fund. And whereas the Next Generation Technology Fund doesn't have a rebate, it's because we are offering you the clean share class, which is already the cheapest share class that a retail investor can access. Finally, fantastic returns in the past 3 years from both of these funds, ranging from 39% to 47% in an annualized basis. Next slide, please. Okay, secondly, we have the Fidelity Global Technology Fund as well as the Franklin Technology Fund. So let me start with the Fidelity Fund. It's a pretty unique fund. It invests into 3 buckets of companies, namely growth, cyclical, and special situations. But what's really cool about this fund is that the final resulting portfolio, it demonstrates lower momentum and lower growth characteristics, which is pretty different in the sector of technology, where many other peers have high growth and high momentum characteristics. So while this one is already pretty attractive on its own, I would personally recommend you to use this fund together with other technology funds so that your overall technology portfolio can perform well in all kinds of market cycles. And then we have the Franklin Technology Fund, which is a portfolio of the best ideas from across more than 20 subsectors in technology space. What's really cool about this fund, again, is that it has the allowance to invest in private companies as well. So if you invest in this fund, you will not only gain access to the usual public companies out there, but also the private companies, which retail investors don't typically have a good access to. So as you can see, again, we have arranged for a pretty good trailer fee rebate with the respective fund managers, and the resulting fees are pretty attractive. Next slide, please. Finally, we have the 2 funds from Allianz Global AI, as well as the Neuberger Berman 5G Connectivity Fund. So as you can tell from the name, these funds are more thematic in nature. Instead of investing in a broad technology theme, they tend to go deeper into a specific theme like AI or 5G. So these funds are a good way for you to express your view if you think that sectors like AI or 5G will perform well in the future. The Allianz Fund especially has a CPF share class as well. So you can invest your cash, SRS, and even your CPF when you choose this fund. The Neuberger Berman Fund is relatively new in Endowus. We just onboarded it by the beginning of this month. And like I mentioned before, we're always looking for the best funds out there. If we see any new opportunities, we will be sure to onboard them on Endowus to offer you guys. Again, we have arranged for a pretty good level of rebate, resulting in a low cost of investing for 2 of these funds. Next. So here's a quick comparison of how much these funds will cost if you were to buy them from other platforms like Poems, Fund Supermart, and DollarDex. So as you can see, Endowus is the only platform that offers a trailer fee rebate to lower the final cost of investing. And even after you reflect the Endowus access fee, which is 30 basis points, the final cost is still cheaper than any other platforms out there. it's also worth pointing out that not all the funds are available in all the platforms. So for example, the Fidelity Fund and the Neuberger Berman Fund is not available in Poems. And for example, the Next Generation Fund as well, we are the only platform that offers a clean share class. So if you were to buy this fund from other platforms out there, you will have to pay a higher fee. Finally, maybe you might want to wish to note that the Allianz Fund is showing the fees for the cash and SRS class, and the CPS share class is even cheaper than this. So that's it for the range of technology funds that we have here at Endowus. Let me pass my time back to Sam.
Great, thank you, Kyungju, and really excited to launch the satellite portfolios. As you know, we espouse a core satellite allocation to build your personal investment portfolio. Every investor should begin with core, which is your globally diversified strategic passive asset allocation that has been built by the Endowus Investment Office to optimize for risk-adjusted returns and low cost, and to build wealth over the long term. And we have flagship and also the first in the industry to launch a institutional grade ESG solution for investors. And then the satellite portfolios today just launched easy to use, off the rack, one-click solutions that are institutional quality portfolios. And the 6 portfolios that we've launched are technology, global real estate, mega trends, China equity, fixed income, and then low volatility fixed income, which used to be called UDP, which was a fun name, but this is a much more accurate name and sits between our cash smart solutions, which are your low yield, safer kind of cash management, treasury management solution, and the 100% fixed income solution. Because clients have requested us something that's a bit safer than the 100% fixed income, we've built this low volatility, unconstrained total return fixed income solution for you. So today is about the technology portfolio, and this is the allocation to the various funds. So the 3 managers are the core managers that anchor the portfolio: the Fidelity Global Technology Fund, the Franklin Technology Fund, and the 2 BlackRock funds make up the bulk of the asset allocation. And we round it off with a small allocation to the Allianz Global AI Fund as well. And Kyungju went through the cost, but the overall portfolio level cost as a result with these weights are just above 1%, which is the target that we have. And if you look at the portfolio level performance and the risk adjusted returns, I would say that, you know, we are capturing all of the upside, managing the downside, because the worst 1-year return is only bettered by a narrow US IT sector, which has been on a tremendous run with no real corrections. The 1-year worst outcomes have been, you know, just -1% versus the, you know, the bigger losses that we saw in the globally diversified tech portfolios, but also it captures the upside. So while there's a slightly higher volatility, I think the Sharpe ratio is pretty impressive. And we built a portfolio that is, you know, less volatile, especially in periods of correction, to minimize the downside. But also it provides broad diversification to sectors, opportunities, and obviously, as Kyungju highlighted, you know, a few of these funds actually invest in private unlisted companies, and we'll talk about that a little bit later. So with that, I'm gonna jump straight into the panelist company introductions. So first Ben, and then Radhika, and then Paul will introduce their respective companies for those that are less familiar with the company. So Ben, an introduction to BlackRock, please.
Yeah, sure. Thanks, Sam. Hi, everyone. Happy to introduce our firm, BlackRock. We are the world's largest asset manager nowadays in terms of asset under our management, and we are managing around $9.4 trillion assets across different asset classes. We are trying. We're also very big in terms of the operations. We have about 16,000 employees and serving clients from over 100 countries. We have offices operating in 35 countries and 25 investment centers globally. Can we move to the next slide? We aim to deliver to our clients not only the outcome and the returns, but also the convenience, value, and the transparency. We invest in across different asset classes, from various vehicles, from active equity to active fixed income, and to ETF and index under our iShares brand, and from cash management to multi-asset and to alternative assets as well. On top of the investment teams in different business divisions, we actually have many other strong supporting teams in order to serve our clients better and enhance our performance, including the capital markets team that help us to source the deals, and the BlackRock Investment Institute, which is serve as an internal think tank to form our house view on the macro and on the asset class view as well. Investment stewardship team actually who help engage with companies on the governance issues, and we also have a very strong risk and quantitative analytics RQA team that actually help on the risk control and the risk monitoring for all of our portfolios. And we have BlackRock Sustainable Investment Team who actually can partner the investment teams to provide the solutions, leadership, research, and the tools for sustainable investing that actually become more and more important nowadays. And the data and the technology team, yes, we actually see ourselves as a tech-enabled company, and we have a very strong franchise in tech solutions through our portfolio management system, Aladdin. And we have many other teams, and we believe the collaborations of those teams and the investment teams lead to the success in our business in the past. With that, I will pass over to Paul.
Yep, sorry, I got the order wrong. It wasn't Radhika, it was Paul. So thank you. But I'm always amazed that a lot of people know about BlackRock and they think iShares and the passive, but there's so much more BlackRock does. And among the active strategies, technology has been an anchor and has performed so well. So I just wanted to highlight that. Over to you, Paul.
Thank you, Sam and Ben. I would like to briefly introduce the firm Franklin Templeton. So Franklin Templeton is a global leader in asset management, and we currently serve clients in more than 160 countries globally. And we've also been in the asset management industry for a really long time, over 70 years. And we have garnered from that a wealth of experience in serving our clients. And currently we manage around $1.5 trillion globally. Next slide, please. So as you can see here on the left, the asset classes that we cover are across a wide gamut, and they range from traditional asset classes like equities and bonds to more unique and specific areas like alternative investments. And on the right of this chart or this slide, you also can see that we have a range of investment brands whom we term as specialist investment managers, or SIMs for short. And they help us provide more targeted and specific areas of investment expertise. And this allows us to leverage off a strong platform to better provide for a broad and yet deep range of investment solutions for our clients. And next slide. And last but not least, of course, at Franklin Templeton, we are really passionate about investing in technology. We aim to own the best tech ideas in both established public names and also emerging private companies that are driving digital transformation. And we really have a very long-term perspective. And most of the team that's currently managing the portfolio is based right in the center of the action in the Silicon Valley itself. And as a result, we are very happy to share that our strong track record is further testament to our high conviction in finding the best technology ideas. And I hope these 3 slides has helped given you a good background to the firm and our DNA in technology. I'd like to hand over the time back to Samuel and Radhika.
Yep, I think Radhika's next. I just want to say that, just because BlackRock is 9 trillion, 1 trillion is not small change. Very few asset managers globally have $1 trillion in excess. And Franklin is one of the biggest firms and a very important strategic partner. So very happy to have you here. Next up is Fidelity and Radhika.
Thank you. So if we move to the next slide, please. I'll give you a bit of background on Fidelity. So we are a global investing and savings business, and we manage about 600 billion of assets for our clients and administer about 180 billion additionally. Our clientele, they're very global. They're also very diverse. So we service everyone from private individuals to sovereign wealth funds. If we move to the next slide, you'll see that, as a fund house, we're quite differentiated. And the reason for that is that we're privately held, which means that we can have a lot of focus, a lot of stability, and have a very long-term horizon that matches our client needs. We're also focused on developing and maintaining our rich expertise. So if we turn to the next slide, you'll see that we have a very global research network and very close company relationships in local geographies that can support investing across asset classes. And I guess finally, what I would say is that we are purpose-led as an organization. So we focus on sustainable long-term outcomes for our clients. Thank you.
Wonderful, Radhika. And I think, Fidelity has multiple organizations. I think as a group, I saw that they manage about close to $5 trillion of assets. I think Fidelity International obviously is the international arm that Radhika is a part of, and which manages the fund that we invest through. Wonderful. Three amazing companies that are very value aligned to Endowus, really working hard to solve investment problems for our investors, both institutional but also retail. So very glad to have you guys here. And we're going to jump into the questions. And the obvious first question, guys, is going to be, why invest in technology at all? Why invest in this particular sector? So I'm going to give each of you a chance to reply. And we have some slides prepared as well. So just to help people visualize and see what it means. So we're going to go the other way and start with Radhika. Why invest in technology?
Thanks. So I think the first thing is that technology allows exposure to global growth opportunities. If you look at tech stocks, they've led the market in the last 5 years, and there's a huge opportunity cost to not investing in technology. Companies in the sector, they improve efficiency, they improve productivity of processes. And in fact, the companies themselves are so disruptive that their products and services are basically taking share from many other sectors right now and from their value chains. In many cases, they also create entirely new marketplaces and revenue opportunities. This is pretty much reflected in the growing market capitalization of technology stocks in mainstream indices. And you can see this on the slide that we have here. If you turn to the next slide, I think it'll become quite evident that we're very much at the start of the digitization process. Over time, we've seen the costs of compute, processing, storage, etc., come down very progressively. And we've seen a spread of networks. And the pace of tech adoption has gone up very, very substantially. So it took about 75 years for the telephone to be adopted by about 50 million people, but it took about 35 days for Angry Birds to achieve the same penetration. If we turn to the next slide, you'll see that there's a or maybe let's stay on the previous slide. The pace of adoption is basically absolutely key, and the addressable market is very large. And I think my final point would be that management teams, they know how to deal with disruption themselves because they are the disruptors. And many of these companies have been through the tech bubble, they've been through the credit crisis, so they know how to run nimble, cash generative businesses right now. Thanks.
Okay, wonderful, Radhika. What about you, Ben? Why should investors invest in the technology sector?
Sure, I think many investors already know that the technology has been the best performing sector in past a decade or two. The strong performance is actually, I think, attracting a lot of investors to the field already, but I have to say it is backed by the very strong growth of the sector. In our view, tech investment is actually investing in the better future. Innovation and technology represents the competitiveness. For individuals with better technology skills, we can see those people maybe have more efficient in jobs or even in the leisure events. For companies or corporations with better technology, they can actually either serve their customers better or better control the cost. So we can say that technology is getting more and more important in people's daily life and the productions, which is indeed the background of the strong demand for technology in recent years. In past 20 years, technology has driven 35% of MSCI equity returns. The tax weight in the index has grown from 6% to 32%. More importantly, the innovation pace is actually accelerating nowadays compared to the past. Just consider that the tech improvements in past 10 years, from 2010 to 2020, and compare that to from 2000 to 2010, or from 1990 to 2000. So you can feel the difference. How much time spent by people in tech products nowadays compared to 10 years ago or 20 years ago, that is totally different. The same applies to the corporations. So the growth remains strong and even accelerating, and this is the context why we should consider investing on technology. If we move to the next slide, we understand there are many factors people are considering when deciding should or not invest in tech at this stage, including the interest rate, macro environment. However, we have to say the previous strong performance of technology in the past 20 years passed through the many cycles that actually interest rate were much higher than current level, or actually there were a couple of like rate high cycles. In the long term, we actually believe it is a fundamental trend to drive the market performance. So fundamental is about the future growth. So if you look at the themes we listed out here, there are so many areas that we can see potential secular growth in coming years, including the EVs, 5G, artificial intelligence, cloud computing. The trend is actually the broader application of technology globally. Take cloud computing as an example. It enabled employees to work from home and access to the data wherever they are, which is very, very important, particularly in this like pandemic period. EVs, electric vehicles, actually is one important solution to the transportation emission of carbon and for people to fight against climate change. So investing in tech, in our view, is investing in such a future trends that help reshaping the global economy, which is very important. Back to you.
Okay, great. We're going to move to Paul.
Thanks so much, Simon, for the question. And there's so many factors that I can take more than an hour to talk about all of them. But I'll just focus on the three main ones that we feel are really important. Firstly, there's not an increasing need for companies to digitally transform. And what we really mean in layman terms is that companies are now needing to continuously convert their data from what typically is in analog format to a digital one. And by doing so, this will help them to better store and access this data better, enable easier flexibility in sharing this data and the insights with their clients. And eventually, all this will help scale and improve their business models over time. And very closely related to that is that we have seen a significant shift as well in consumer behavior towards embracing digital forms of content and information. So for example, less people are reading print, they are watching more videos instead. More people are getting more heavily reliant on the mobile phones to function daily. And then we have seen also a large penetration of digital usage across the various age groups across the globe. And we feel that this will all further grow over time. And last but not least, we not only view these growth themes and the need to digitalize in isolation, as you can see on this slide here, but we feel that all these growth themes somehow correlate, and there's an increasing formulation of an ecosystem that is emerging from digital transformation. So we feel that companies and people that can better structure their businesses and their way of life to leverage these synergies well will stand to only not benefit from this directly, but they will also help benefit the companies and sectors and the people that they choose to collaborate with. So we feel that this is really a very tremendous opportunity and a lot of tailwinds that we'll be seeing in the years to come. So with that, I'll hand over the time back to Samuel.
Great. Thank you so much. Great answers, all of you. And I guess one of the things that keeps coming up is obviously technology has done so well. And the underlying fundamentals of technology have recently been supported by, the unfortunate circumstances of COVID, but it has led to rapid adoption of digital solutions, digital technology, and our daily lives, as you guys have suggested. We watch Netflix all day, Google, Amazon, Facebook, Instagram. It's our daily life. So are we now approaching a stage where we're beyond the explosive growth in technology? I wrote an article recently about how people wrongly apply the laws of physics to financial markets. We say things like, oh, what goes up must come down, when empirical evidence and historical trends suggest that markets actually trend up. So there's misperceptions that exist in markets, and investors naturally, when things go up, think that, hey, it's time for it to go down. So maybe if we can provide some fundamental reasons why the growth in technology could continue into the future. So we have two slides, one from Radhika and Paul, maybe to rebut this question that many people throw at us.
So I think I'll start off. Basically, we remain very constructive on the technology sector because fundamentally speaking, there are plenty of tech companies that can outgrow GDP over the long term. Technology, we believe, is addressing not only the needs of the cyber world, but actually the real world, and that's absolutely key. So if you look at the slide we have here, many parts of our economic lives are still early on the digitalization spectrum. And as a result of that, there's a huge addressable market that remains. And even if you think about where things stand right now, If you think about all of the chatter around reopening, etc., technology plays an important role. If you think about travel planning, booking, workforce planning, etc. When you think about infrastructure spending and stimulus, which is another thing that's been quite topical, digital investment is taking on a very big role over there. So in terms of broadband deployment, in terms of 5G networks, etc. One of the previous speakers mentioned, even all the environmental agendas coming out right now are supported by tech. So when we talk about clean tech or electric vehicles, the key inputs into those are very much technology based. And that's the difference that the technology sector is seeing right now versus the bubble of the 2000s. The demand is very much real and it's actually very strong. And as a result of that, structurally, we believe that technology remains a good place to be invested. Thank you.
Great. Maybe Paul can also add comments.
Thanks, Sam. And I agree with a lot of what Dika was sharing as well. And we similarly see tremendous growth opportunities in the technology space due to the long-term secular trends of digital transformation. And what this really represents is the increased leveraging of technology to better understand customers and processes. Ultimately, this will all improve how industries operate. So one important facet of this that we would really like to emphasize is that businesses that embrace digital solutions, they really have strong and recurring relationships with their clients. They are very rich in data, and they're able to leverage off that data to gather important insights during customer engagement to help shape behaviors. So we feel that there's also a long way for investors to fully appreciate what is coming next, as the extended pandemic period that we saw since last year, it helped to teach businesses, employees, customers, people that we all could be more productive and more balanced lives could be garnered using the new digital skills that we built during the crisis. So we feel that the fundamental growth we saw during the crisis for a subset of companies and teams will broaden and extend as the world reopens. And our discussions with many of the companies we follow indicate to us that this is what's happening exactly. The only difference today as compared to the past is that we need to be much more selective in what we invest in to reap the returns that we aim to be having over the longer run.
Sure, thanks for that, Paul and Radhika. So I think at this point, we understand that the tech sector is not just like a short-term hype, but it's rather like a long-term growth sector that is already impacting our various areas of our lives today, as well as have the potential to change even more of our area in life into the future. But maybe at this point, I might take this a bit further and try to ask you, what exactly does it mean to invest in technology? Are there any specific subsectors or themes that you think that especially will lead to higher growth? Like Paul just mentioned, we have to be selective. So what do you think are the subsectors or themes that we have to be involved to participate into the longer term growth? Maybe this time Paul can go first, and then Radhika, and then Ben.
Absolutely, Kyungju, and that's a great point. So we have chosen to share today 3 areas that we feel are really exciting in the area of digital transformation. And these are the areas of cloud computing, Internet of Things, or IoT for short, and e-commerce. So if I move on to the next slide, and I'll cover each of these individually. So the first theme that we really like is the cloud computing services area. And this has been really a top priority for many businesses as it helps to scale the businesses as shared earlier and allows data to be stored and accessed in a more flexible manner. And what's really exciting is that the spending on cloud services is yet to reach its peak. In fact, we forecast overall spending on cloud services to be upwards of US 330 billion by next year. And for the recurring revenue that these companies can garner to really be growing very strong over time. So that's one area that we are really excited about. And it also functions as a strong balance to a lot of the other sub-themes that we are seeing in the digital transformation space. Next slide, please. Another area that we find really exciting, but it's not really often talked about, is Internet of Things, or IoT for short. And essentially what this concept represents is the concept of connecting a device to the internet and to other connected devices. So if I were to use an example to elaborate on this, if I were to use a clothing store, for example, and if the clothing store owner would like to garner more useful information from the people that are visiting the store, what could happen is that sensors could be used to detect which areas in the store are most popular so that I can place the items where customers linger the most. right? They also could have devices linked so that sales data can be automatically linked to supply sources, so that popular items can be replenished more quickly. So these are some examples that what a small business owner can do. But imagine the growth and the tremendous opportunity when more and more businesses embrace these devices and the interconnectivity that they provide. And we expect this trend to further explode, and we expect close to 300 billion connected devices to be out there in the year 2023, and gives us great opportunities and ideas to invest in this, what we call disruptive space. And last but not least, in the next slide is e-commerce. And I think many of us have been embracing this, myself included. And we are seeing more and more people not only embracing online platforms, but also spending more when they are on these online platforms. So we are seeing not only a large growth rate in e-commerce platforms, but also an increasing penetration rate of the customers as well. And I give you a stock example. For example, for e-commerce companies, you can't get much better than Amazon. And as we see supply chain constraints starting to ease up, a company like Amazon will be well positioned to take advantage of this. They are a really solid e-commerce logistic network. So we see a lot of opportunities to be investing into this area. And these are some of the just the great examples that we currently like in the digital transformation space, Internet of Things, cloud, as well as e-commerce.
Thanks
So
for
back to
that,
you,
Paul.
Kyung-Joo.
Yeah, really interesting themes like you just mentioned. We are probably making use of these themes in our daily lives already. I'm really interested to see how further it can grow into the future. But maybe we can talk more about the specific subsectors within the technology sector and then in the more, I guess, the traditional classification. So over to you, Radhika.
Thanks. I think the first point I want to make is that most people think that tech is quite monolithic, that all the business models are quite similar, but there are actually many types of business models. Some are more cyclical. So if you think about semiconductors and communication equipment, then there are others that are more defensive, such as software. And there are others that are winner takes all, like the internet space. So while we tend to make all our decisions in the portfolio on a bottom-up basis, and we don't tend to take macro views, but there are some themes and some subsectors that are quite interesting. And actually, you will find that I'm repeating a bit of what the previous speakers have said, but I think that just underscores the fact that these are real investment opportunities right now. The first one is digital advertising and e-commerce. And, I'm not going to go into much detail on that because I think it's very well understood. The second one is cloud computing. And while I completely agree with the previous speaker's points, I think the kind of additional layer I'd like to add over that is that, we are seeing quite a bit of change happening in the cloud space as well, with developments around the edge computing taking place, with lots of rivalry happening between cloud giants, which is leading to much more investment, and also with new applications coming up. So think about, streaming games as a good example, or cloud-based gaming. Digitization, that's something that sounds quite broad, but basically across the board, industries are looking to become more efficient and more resource efficient, and to gain new insights into customers' behavior, into business processes, etc. And they're doing this via digitization. Part of this does require the Internet of Things, which is mentioned by the previous speaker. I think one thing that hasn't come up as much yet is just the developments around the automotive sector. So autonomous vehicles, electric vehicles, basically all the component providers into many of the changes taking place in the automobile sector are very much tech-based, and it's definitely an area where we believe there is structural growth opportunity. Similarly, 5G networks, we're seeing basically faster, more reliable wireless data transfer taking place. And both telecom infrastructure providers and in fact some telecom wireless operators also are looking quite interesting at this point in time. I think most people take gaming as a given, that this is something we do in tech, but actually gaming is seeing quite a change as well, because we're seeing quite a widening of the market, demographically speaking. You're seeing more women players, you're seeing a lot more change in terms of the age groups that are gaming. And there's a huge potential for new revenue generation because there are new features coming through. The total cost of getting to a customer is also going down, as you can target them directly rather than going via console, for example. And finally, I guess one theme that is less talked about is just the general build out of technology that's taking place in China, where there is going to be a huge amount of capital deployed to develop a local semiconductor industry, for example. So as you'll see, the opportunity set is quite vast and it's quite differentiated. And that's exactly the reason we believe that, investing in technology allows you to get exposure to global growth opportunities right now. Thank you.
Thanks, Radhika. Really appreciate those points. I think one thing that you just mentioned is the point about China. It's an interesting topic to talk about right now, and maybe we'll touch upon that question later on. But over to you, Ben. What do you think about this topic?
Yeah, sure. Thanks. We actually use our own classifications of the tech subsectors rather than using the GICS definition, as we believe our classification actually makes more sense and better capture the fast-moving pace within technology space. We listed here the 7 subsectors in our definition and the sub-industries of each subsector. We see the potential opportunities. I will share 2 examples here. Taking semi first, semiconductors, that we actually believe there will be more investment into the field for the more capacity, especially to the high-end products. But compared to the foundry business, we actually see better opportunities in the capital goods companies within semi industries. Another example is like new industries, which actually in our definition is a subsector defined as a disruptor of traditional sectors, such as telemedicine or AI pharmacy or AI drug discovery companies to healthcare, or the green technology to the energy sector. So these technology companies are supposed to take the market share from the traditional companies in other industries. Given they are simply better, they are actually more cost efficient and provide convenience and other advantages compared to the traditional companies in those sectors. So that actually means potential huge business demand for those companies and the market share there. So, but overall, we see good opportunities across different subsectors in our own definition. Back to you.
Thanks so much, guys, for that. I think at this point, it's now pretty clear that we can easily achieve diversification by investing in technology, just because the range of opportunities available across the various subsectors and themes are so vast, which brings us to the next question. So how do we ensure that our technology portfolio is diversified in terms of region, not only subsector, but region as well? Because I think when we think about technology, the first thing that comes to our mind is usually the American companies, the US players out there. So how do we make sure that we accurately capture the opportunities that are offered by companies from other parts of the world in terms of technology? Maybe Radhika, you can go.
Sure, happy to. I guess you can answer this question in 2 ways. One is from the demand side and one is from the supply side. So let's start with the demand. From the demand standpoint first, digitization is happening globally. It's a global phenomenon. And while there may be differences in how penetrated technologies are in different regions, but the demand dynamics remain positive throughout. And basically, they're coming from the consumer, corporate, industrial, and government side of things. And this demand can be met by local companies or it can be met by global companies. So while we talk about Amazon quite a bit, there's no reason that you can't invest in a local e-commerce player in Japan, Russia, Latin America, etc., which we do in our various portfolios, or why you can't invest in a software developer in Europe or even the UK. So meeting kind of the demand side of the equation can be both a local and global phenomenon. And it depends on the company that we're talking about. It's very much a bottom-up decision. But I think the supply side is also quite interesting because tech value chains are pretty global. We see that there are manufacturing hubs that have come up. If you think about Taiwan, Korea, Shenzhen, etc., and these are quite important and they make for interesting investment opportunities. Essentially, they are set up next to larger manufacturers because they can improve the efficiency of the overall manufacturing process by just bringing a high level of specialism. And I think that's a particularly relevant point right now because of various trade disputes and trade trade restrictions that have come up in recent years. We see that, if you look at Taiwan, for example, or even Korea, on the semi-manufacturing side, you see quite large clusters of semi-fabs or factories that have come up. They're usually called mega fabs. And these give quite a lot of economies of scale in servicing other players. So it's very much a global phenomenon. I think you can see the same thing happening when you think about kind of the more software programming side, where I think most of the news tends to be based around Silicon Valley. But, there are other areas that are quite interesting. So when you see, large companies draw down, for example, think about Nokia in Sweden. Very often they actually give rise to local ecosystems because you have good engineering expertise, you have good intellectual property in place. And so you do see that there are local hubs that are forming and make for interesting investment opportunities, and also can lead to disruption of companies that are servicing the rest of the world. I think, we have this slide over here, and the point of having this slide was to just point out that as a percentage of local indices, tech has become quite important. So if you look at the emerging market index or even the Japanese index, you'll see that the tech component is actually quite meaningful, which means that there is a definite global opportunity for investing in tech. Thank you.
For the Radhika. And I'm realizing the portion about China on your slide over here, and since we mentioned China just now, I think a lot of our viewers are curious to hear about your opinions in the Chinese technology sector, because I'm sure that Chinese players do offer attractive opportunities, but it really wasn't too long ago that the market was like super shocked by the regulatory crackdown that the government has had on some of these Chinese technology companies. So how do you think that we should view this regulatory and policy risk arising from China? Maybe we can request for Ben's opinion first, and then Radhika should go next.
Sure. That it is a very good question. That especially for this year, after some tightened policies in China, especially for the internet space. Well, our view toward this is we did not see actually one-sided and active policy stance in China in terms of the tech regulation. We actually see divergence of the tech regulatory stance in different subsectors within tech space there. We did see that, as I mentioned, we did see tightened trend in some internet space, especially in those we call so-called platform internet companies. That is because those companies are making a lot of profits based on their monopolism or so-called monopolism concern on their platform business, including like e-commerce, food delivery, or entertainment content, etc. But on the other side, as Radhika just mentioned, that we do see pretty big support to the foundational technology in the other fields, including like semiconductors. And as I listed here, there is a very ambitious technology self-sufficiency target set by the government, and actually quite a strong supportive policies in those fields nowadays in China. So it is divergent rather than one-sided on the negative side, but just in the different fields within technology. So if we look at the performance this year, we're looking at the semiconductors or electric vehicles or EV companies, etc. Like EV batteries. The performance have been fabulous this year, and that applies to some green technology companies as well, which is supported by the net zero target announced by the government this year. So in our view, China is a very broad market with many moving parts and many different sub-industries. As an active manager, we need to judge on the regulatory trend and its fundamental impact to different subsectors and different companies and make the right decisions. So it is still a stock selection market in our view.
I guess I can add to that. You're absolutely right. There has been a lot of news flow around regulation from China. And, it started with the delay of the Ant financial IPO, fines against Alibaba, concerns around ADR listings, restriction in terms of gaming time, etc. So it has been quite noisy, but incrementally aware of the view that the news is on the margin less disruptive. And, it is basically China setting guidelines. It's China regulation on tech trying to catch up with what's happening in the West. And broadly, from what we can see, we've seen more around content regulation, etc. We have not seen a disruption of the business models. So if you think about risk reward, there's really no incentive to cause a disruption to a sector that contributes so significantly to economic growth in China. Chinese technology companies are very important. And on the margin, given all the uncertainty that we've seen recently, many of the stocks over there are actually quite attractively valued from a middle to long-term perspective. So while there will be some noise in the medium term, we actually think that China is quite an interesting hunting ground for opportunity. Obviously, it's very, very important to remain stock specific and to understand the dynamics of each individual business within the overall regulatory framework. But that's something that our research allows us to do. And as a result of that, we remain positive, but obviously very stock specific. Thank you.
Great. Thanks, Ben and Radhika, for that. Actually, when you're investing, and obviously I used to be an investor myself, portfolio manager in public market growth equities, and invested in the tech sector, extensively. And, Morgan Stanley Investment Management, which I was a part of, was a top-down, bottom-up investor. And that's how a lot of people break it down. In the Q&A in Slido, there's a few questions about this macro environment. Interest rates expected to increase. How will tech portfolio be impacted? With the hawkish Fed, is it the right time to dollar cost average into tech? If yes, why? These two questions stand out. And it kind of ties in with our, I think, the next section with the question about trying to introduce your own ways of investing. And especially if you can tie into this kind of macro environment. And we talked about the sector diversification. We talked about the geographic diversification. Do you do any top-down, whether it's macro, thematic, sector, or country-driven allocations? And especially for Ben, who's going to kick us off, I think that it'd be great to hear whether those kind of thematic buckets are seen as top-down approach, or is it just all pure bottom-up? And bottom-up, for those who are less familiar, pure stock picking, idiosyncratic stock picking. So maybe we could kick off with Ben on BlackRock's approach to investing in technology. What sets you apart as an investor, and top-down, bottom-up approaches? That'd be really helpful.
Yeah, sure. Thanks, Sam. I think that is a very topical question in recent days, given the possible Fed tapering in coming months, etc. So we understand there are a lot of concerns about the rising interest rate or inflation or the different macro environments for tech investment in the moment. But in our view is we need to focus on the bottom up. We are actually bottom up as well. The reason behind it is actually the macro is cycle. But our aim is to generate long-term returns for our investors, so that actually we pass through different cycles. So in order to be able to do that, then actually we believe investment purely in the fundamentals of the companies actually can help us with the long-term investment returns, and that's what we did in the past, and we actually did pretty well, and saw a very good result from our long-term track record for our tech strategy. So some of the key features here, actually, we are pretty experienced in terms of the tech investment already. 2 PMs on average have 22 years of experience. And we are based in San Francisco, and we are actually one of the largest tech portfolio management team in the world, with actually pretty solid reputation for tech investment. And for exposures, actually, we do invest in different kinds of technology companies, especially in the emerging tech companies, which is actually our expertise. We like to invest in tomorrow's winners rather than sitting in today's leaders, given actually to invest in the right stocks or right candidates of tomorrow's winners can bring a better return for investors for long run through investment horizon. We are diversified. Back to Sam, your questions about how we manage the risk about different macro environment. As I mentioned, we invest on stocks or holdings based on our view on their fundamentals. So it's like a bottom up. But on the portfolio construction side, we actually do take a diversification approach. Like we in our strategies, typically we hold more than 100 companies as holdings in the strategy. That's so that actually we control the sizing for each particular individual holding, so that can actually reduce the risk on single stocks in our view. And we're actually pretty diversified in terms of the market as well. We try to increase our allocations outside US, etc. So this is all kind of diversification serve as a risk control purpose as well. But for long-term speaking, as I mentioned in previous questions, we actually is a strong believer that the long-term equity bottom-up fundamentals drive the performance rather than the macro. So macro is a cyclical. It can come different cycles every a couple of years. But if you look at back for the past 20 years, we have been passing through those cycles, like in different environment for interest rate increase, sorry about the camera, and also a different environment for interest rate were much higher than 10 years ago compared to now. So yeah, we actually do not too much concern about the macro factors, which may trigger some near-term volatilities, but as long as our holdings fundamental stories remain intact and materialize in the longer term, then actually we are pretty confident in terms of the performance still. So yeah, that's our view. We do bottom up. Back to you, Samuel.
Okay, great, Ben. That's a great answer. And technology is great, but also it fails us sometimes, like camera. So okay, over to you, Radhika, for the same kind of question.
Okay, so I'd like to make a couple of macro points before talking about how we actually invest, which is very much fundamental bottom-up based. I think if you look at technology companies right now, if clients are concerned about inflation, I would say that technology companies have a lot of pricing power. So our technology analysts have actually just done a tech symposium where many of them have talked to companies on the hardware side. And there's very robust demand right now for technology inputs. And a lot of these companies are actually looking to increase prices, which is a fairly rare phenomenon because usually, tech tends to get commoditized. So if you're worried about inflation, these companies are very much able to pass the inflation on to clients who are actually willing to pay because the demand far exceeds the supply. That's the first point. The second point is that if you look at tech balance sheets generally, they're very clean balance sheets. So if you're worried about rates, etc., you obviously need to be aware of the kinds of companies you own because obviously the growth path of the market has re-rated substantially in recent years. But if you look from a fundamental perspective, these companies are actually clean balance sheets. Managements know how to manage through difficult periods because many of the management teams are actually ones that have either come through the tech crisis or the credit crisis, etc. So I think from that point of view, technology companies stand very well resourced. Now, as far as we are concerned in the Fidelity Global Technology Fund, we're pretty diversified across different types of technology themes and different types of companies. So all the decision making is done very much on a stock by stock basis, with us aiming to basically find mispriced winners at any given point in time. Now, the thing we do is that we obviously need to know about technologies, right? And the reason we have these 4 boxes on the slide over here is just to emphasize that tech investing is not just about knowing technologies. You also need to know the companies. You also need to know the valuations of the stocks that you're looking to buy, and you need to understand sentiment because sentiment can become an important driver in markets. So when we're looking at evaluating a business, we're looking at it in a multi-pronged fashion. If we can move to the next slide, please. I think this was mentioned before, but basically our portfolio is split into 3 different types of opportunities. So these are growth, cyclical, and special situations opportunities. The idea is that you combine different types of business models to create a portfolio that can perform across different market environments. And this has actually held our clients in very good stead over the long term. As was mentioned previously, you clearly do see that there is an anti-momentum bias that feeds through as a result of this process and as a result of the fact that within the technology space, we are actually quite valuation conscious in this fund, and that does differentiate us from many of the peers. Thank you.
Great. And I'm going to hand over to Paul, and I think it's only fair if Paul is given an opportunity to discuss this process as well. But while he's doing that, I think maybe if we can touch upon this additional angle of being able to invest in private companies. So several of the funds, especially even like right now, the portfolios of BlackRock's 2 funds and Franklin Templeton's technology fund owns some private companies. So which is very unique to the technology sector. So Endowus is a private company and growing well, and valuations are rising. But there's also a lot of other investment opportunities, not only in fintech, which is where Endowus is, across the whole technology space. And it's interesting that, you know, traditional public market investors like Franklin Templeton and like BlackRock have now less constrained investment criteria where you can actually invest in private companies. And this is really interesting because this is another source of returns, because, you know, we're seeing private companies stay private for longer and IPOing later in the stage of growth. Which means that you're missing out on the opportunity to invest in companies earlier in their growth cycle. So with that, maybe Paul, you can just talk to some of the things that we discussed, and then, you know, answer the specific questions about, you know, investing in private companies and how that makes sense for traditional public market investors like yourself. And after that, if Ben, you want to add any comments on this, you can do that as well.
Thank you so much, Sam. Much appreciated. And I'll first, before talking about the private companies, I'll talk about some of the factors that we look at when we invest. So it's quite similar to the previous speakers in the sense that we try to focus on the bottom-up stock selection and let the stock selection effects contribute to performance over time. And some of the characteristics that we look for companies today are good EBITDA margins or good profit margins, increasing levels of recurring revenue, and also balance sheets that are strong and preferably with a net cash positive balance sheet. Of course, in private companies, we know that that is not often the case, but for public companies, these are some of the characteristics we tend to look at. And we focus on this because we want to be buying higher quality technology companies that we know that can grow over time really well for our clients. And moving on to the topic of private companies, it's really a key part of our process, as we really have seen that the strategy of investing in private companies has allowed us to see disruption before our peers, to really help generate alpha within a really hard to access space. So we invest in private companies to learn more about important companies and trends that are emerging in the technology space. But that said, privates are typically a smaller portion of our portfolio in terms of rate and performance generation. But where they really hold their weight is that the insights that they give us, especially at the earlier stage, help us make better public market investors. And also investing in private securities does entail some risk unique to the asset class. So we really are very proud to share that we have a strong level of expertise and experience in assessing these ideas. And this is really important, especially when investing in a pretty unique asset class. As we all know that private markets information is not as diverse as and is easily available as compared to public markets. So we need to be really much more versed in this area.
Great.
And if we could move on to the next slide, I would like to share an example of a company that we ran, and it's also quite interesting because I think Radhika raised this very interesting point, and I categorically agree with her that in the cloud space, edge computing is really disrupting the space, as this is becoming an enormous market and ripe for the taking. And just to share this example of Cloudflare, so this is a company that we participated in pre-IPO, and investment managers based in the Silicon Valley area, they had the opportunity to meet and engage with management in the year 2015. And then from then on, they saw a great opportunity to invest in the company, and they did so. And now I'd like to share that the company is a good example of one that's now in the portfolio and is now a traded stock. And one of the areas that they really are making a lot of strides in is in the area of edge computing, whereby we are not only seeing cloud computing disrupting the way businesses are doing their business, but we are also seeing edge computing disrupting the cloud space, right? So given just in simple terms, edge computing for some of our listeners today means that as we run processes on our devices and we store information on the cloud, there's kind of a lag and the distance between our computers and the cloud and where these servers are stored. So what edge computing really does is to kind of aim to bring some of these servers nearer to you for less important tasks, so that you're able to optimize the way that these applications are running both on the cloud and in your local area of business as well. And Cloudflare, in this example, has made tremendous strides in disrupting the market. And we are seeing strong potential for companies like this. And again, this will really help us to identify early opportunities in the edge computing area. And we similarly see other similar opportunities given our exposure in the private markets. So back to you, Samuel.
Great. Anything to add, Ben, on the private side, or we can just move on? Up to you.
Yeah, just very short. I think we have two reasons. I think investing in private side is also very important for tech investment. One is, as Paul mentioned, it is not only about the potential returns from the private investment, but it is actually enhance our insights toward the public traded companies as well. In many cases, in our investment process, when we talk to the private companies, we actually see them as a very potential disruptors or competitors for our existing holdings in the public side. So because they could have some better competitive edge, or new technologies could be replace the old technologies, which was held by the existing in the secondary market tech companies. So that actually enhance our investment insights into the certain industry, and actually can better judge the value for the public traded companies as well. And the other one is the situation or the environment for tech investment is different from 10, 20 years ago. There are many private equities chasing those unicorns or very popular private companies nowadays compared to 10, 20 years ago. So that actually their access to funding is much easier compared to years ago. That actually possibly some of the very good tech companies have been relatively delayed on their IPO stage. That actually means when they come to the IPO for public trading, then actually how mature the company is different from 20 years ago. 20 years ago, they are eager to get an IPO as soon as possible to get the funding, but now because they can get the funding from private equities or venture capitals, they're actually delaying that. But from a certain level to big enough for IPO nowadays, actually there is a very big returns for those big private equity companies. So that actually was the part of the public investors returns in the past, but nowadays it goes to the private equities. So from that two perspective, it makes sense to invest some of our portfolios into the private holdings, but we actually control into a very limited percentage given the liquidity concern as well. So we actually take the balance of the two.
Yeah, thank you, Ben and Paul. I think if we move to Q&A, and I'm conscious of the time, maybe we can take just two questions. One, if I just summarize a lot of these questions, it boils down to two key questions. One is based on this concept of, do we need actively actively manage this sector? Why not just invest in NASDAQ or just invest broadly in passive? Why invest actively? Maybe I can get, the first two of you to answer. Anybody want to take that one first? Why active management works in technology, or should be actively managed?
Maybe I can take the first one, because we actually, BlackRock has a very big franchise in passive investment as well. So invest in technology, in our view, if the portfolio is to invest in the large caps, then actually it will be difficult to beat the benchmark. For example, the NASDAQ, and actually passive investment makes some sense for those kind of investors who like to invest in the large caps. However, investing in the small caps or emerging technology companies, which is our strategies focus on, will be totally different, because those companies are relatively small sized, and there is a very limited weight in index, or even not in the index. Then actually passive investment normally will not capture those kind of early stage companies. But that actually, those companies, because of their highly volatile and with a lot of uncertainties, that actually need a strong active manager investment expertise to do the due diligence and to judge on the potential futures for those kind of companies. Then for this type of companies, active management style makes totally sense to us. So that is why we invest a lot in the emerging tech companies, which our view is the investor cannot capture these opportunities from passive investment at all.
I'm happy to add to that if that makes sense. I guess just from Fidelity's point of view, we very much believe in active management, and as Ben mentioned, it's fine when you're looking at large cap companies, but even there, you do need to be aware of valuations and the right time to own stocks. So growth has to be bought at the right price if it's sustainable growth, and that's what an active manager can do. They can evaluate that. The second thing is that there are very often special situations, events taking place with respect to companies that the market finds quite difficult to evaluate. There may be a management change, there may be an M&A or an M&A optionality, and there may be a kind of old technology company which is investing for growth in the future, where the opportunity is just not well understood by the market. But if you are able to invest earlier than the rest of the investor base, you will have an extra kind of alpha leg or alpha opportunity available to you. As a result of that, very often you can invest in stocks that where a lot of the investors will kind of follow suit once they see that fundamentals are truly improving. You do get the ability to generate additional alpha vis-a-vis, vis-a-vis just going in from a passive option. Thank you.
And maybe just one of those comments as well, a quick one from me, just to give an analogy. I think in the past when liquidity was more available or more widely available, out of 10 stocks, you probably might make good money from 8 to 10 tech stocks. But in today's environment, I think you need to be much more selective, and you probably will be making money from a lower number of stocks. So I think with a lesser amount of liquidity that's going around to invest in, I think generally speaking, we need to be much more selective in how we go about choosing the tech investments, which is why an active way of doing it might be a more plausible approach to be approaching markets.
So the actual question was, why invest in these various actively managed funds, referring to Endowus' tech portfolio. And they made a statement when it is historically almost impossible for such funds to beat the market. But I would just show you the evidence that these four funds managed by three fund managers have actually beaten the market quite well over an extended period of time on an average basis annualized. So, it is possible to beat the market. That's the first point. Secondly, I think as, Ben and Radhika also highlighted, being passive makes sense in certain circumstances. Like if you're trying to expose yourself to broad market returns and you don't want volatility, then, as a core allocation, this is where you want to start and allocate to grow long-term wealth. I think that's perfectly fine. But if you're trying to generate alpha, and many investors do, then you need to, invest in these satellite portfolios, because over the long term, it is possible to generate alpha. But people throw this data that, 70% of funds, active funds underperform, 80% of the funds underperform. But it also means that there's 10, 20 or 30%, and these three fund managers just are part of that ratio of 20, 30% who are outperforming. And it's critically important that we don't just buy funds because our banks or brokers push the funds because they get trailer fees or, higher commissions for selling and distributing and pushing certain products. I think it's very critical for investors to do the due diligence. And if you cannot, then rely on platforms like Endowus, where we provide advice and curation and due diligence for you. We go out and scan the thousands of funds out there and pick the best in class funds, analyzing the characteristics, the investment process, philosophy, and the way they invest, and look at the risk-adjusted returns over the long term, and try to pick the best funds that have outperformed. And I think that's critically important to have an advisor or do the proper due diligence when you are picking actively managed funds, even more so. This leads me to the second question, which is on valuations. Current tech valuations and potential returns over the next 5 years. People want to invest in sectors that are outperforming, invest in, technology because it's going to continue to do really well, but people are worried that it has done well. And this is, again, passive versus active. At these valuations, does it make sense? Some people were saying that there's companies with no profit and revenue reaching 100 billion market cap, irrational exuberance in the market. Is this another dot-com bubble? There was a question also earlier about Franklin Templeton tech fund having higher lucid weighting than Tesla. So EV, I think, is one area where, still not profitable, hugely at least, except Tesla, and people are still investing. But at the same time, I have a question asking, any views on the next Tesla? you know, so people are schizophrenic when it comes to tech. But anybody want to take that question? Paul, maybe.
Maybe Sam, I'll go for that. I think one name that we have that I'm really excited about, and the team as well, is Potera. So Potera was similarly a name that we own. We had the opportunity to discover pre-IPO, and it's now a listed company. And Potera, if you think about it, how it kind of functions is similar to Tesla, but what it does is that it kind of manufactures electric buses instead of electric cars. Right? And they are also having a strong tailwinds in this market. It's quite underexplored. And we own that company, and we are really excited about the opportunities that we see in that. And just to add on one more comment on the valuations bit, I think generally speaking, we do agree that valuations are not absolutely low. But again, this is back to the earlier question of being selective. So giving some examples, we feel that in the area of technology hardware, right, this is an area that could be quite highly valued on an absolute basis, which is why we are underweight that sector. And we are overweight sectors in, for example, and we are very selective in the stocks we own as well. So just to add on a kind of a additional perspective to valuations, it is not the same across the various subsectors within tech, which is why an active kind of approach will help you to decipher which areas to be more selective and which areas to be more generous, right, in allocating your capital.
Great. Anybody else want to add to that on valuations or any other aspect of that?
I mean, I'm happy to kind of reiterate the point on valuations. There's no doubt that valuations have gone up in recent years. But if you actually look at valuations right now vis-a-vis the tech bubble, we're nowhere in bubble territory. That's the first point. Secondly, unlike the tech bubble, we actually have very established business models within tech right now. There's a lot of earnings delivery, there's a lot of earnings visibility, and there's real cash flow being generated by these businesses. There's no doubt that there are some areas that are expensive. So we believe that some of the IPOs have been quite expensive. Some of the high growth software names have been quite expensive because there's been a lot of meme investing and a lot of retail investors following story-based stocks and ignoring kind of long-term and medium-term fundamentals. So we do believe you need to be quite careful in how you're investing, but largely we believe that even if you look at mega cap valuations, they're actually fairly reasonable despite the fact that they've done very well because of the kind of strong moats and the strong pricing power that these companies have. And I guess my final point would be that if you are looking for a valuation conscious approach to tech investing, then our fund is very much inclined in that direction. And I'll leave it at that. Thank you.
Yeah, maybe just my last point that it's not all entirely very rich expensive for across the tech, I have to say. If you compare to last year, actually quite many like COVID beneficiaries, actually the valuation is treated lower compared to last year because the performance is not that strong this year compared to last year, while the earning has been very solid. So actually earnings is up that to trim the valuations from the mathematical standpoint. And also actually some of the hardwares and actually they are trading at relatively low valuation as well. And there are some tech companies actually hurt by the pandemic, like some online travel agents and some like payment companies that are actually got hurt in the pandemic. Also the valuation is relatively reasonable in terms of the historical range, etc. So I don't agree that it is entirely high for the whole tech space in terms of valuation. And on the other side, if you look back for past like 20 years, which actually tech had a very strong run, that at any point of the historical time period that we look back by that timing, actually people will be afraid of the high valuation as well. So valuation is the current or the historical earnings contributed rather than predicting the future performance. And also on your questions about the certain like the electric vehicles industries, which one will be the next certain other companies that in that case, if the investors is take this angle, then my question will be why not invest in some supply chain companies of the EV that no matter which brand they will take market share ultimately, then actually they will get benefited because the EV total pie, the market share of EV is actually increasing no matter which brand is actually winning, which actually similar to like 10 years ago when we were talking about the smartphone supply chain that by that time that actually some of the like the audio systems or optical systems within smartphones also see the similar stories. So that's in our view that yeah, if we are conviction in certain trends of the certain subsector or themes, then the entire supply chain should be considered rather than the only the end products or the consumer facing companies, but also the entire supply chain should be considered. Back to you, Sam.
Wonderful. Great answers. And, obviously this person, you have to look at the chart of valuations during the dot-com bubble. I mean, it's off the charts, completely different from where we are. Leading tech companies are some of the most profitable companies around the world. I think we just highlighted that. And then, various opportunities within the tech sector where some valuations are high, but others are not, as Ben highlighted. And that actually is one of the strongest cases for active management, to take opportunities of the various valuations that are out there. We will touch upon this tomorrow in the webinar. I think Kyungju will touch upon this. So just want to highlight once again, tomorrow's session, back-to-back days, but please join us for the introduction of all of our Endowus satellite portfolios. We'll go through all 6 of them, highlight them, and why you should invest in them from the Endowus Investment Office. And it's a series. First of all, we actually kicked off with the technology one first. Tomorrow is the overall introduction. And then we have 2 more megatrends in China, because we've done real estate in the past with some of our fund management partners. That's going to come every Wednesday for the next 2 weeks. So please join us. And with that, I told these guys that maybe can you stay on 10-15 minutes? We're already 20 minutes past. So I apologize that we kept you on for so long, but it was a real pleasure having you. Amazing insights. Thank you so much for joining us, Radhika, Ben, and Paul, and Kyungju, of course. Thank you, everybody. Have a wonderful evening. Thank you for joining us.